Corporate Finance Investment Banking Overview. Get ready, it's time to take your chance with corporate finance. The investment banker acts as the connection between corporations that need capital funds and investors. So in our picture on the left-hand side, we have the corporation needing funds, needing capital, needing, in other words, money. And then the investors, of course, having the money, who would like to then invest in order to generate a return. The investment banker then acting to facilitate this transaction. Now, the investment banker acting as the middle person here is often going to be taking on a substantial amount of risk as they do that. They design, package securities, make offers, and sell to the public. So in other words, if they pick up the securities from the corporation, they may package those securities, group them together in some format that they think will be marketable then to the public. As they do that, they may be taking on risk because there could be things that happen in that middle component before they actually make the sale to the public. So they're going to be taking on risk as being that middle component to the transactions connecting the corporations that want capital and the individuals. Now, you might be asking, well, what's the difference between an investment bank and a commercial bank? So let's do some quick comparing and contrasting here. If we think about a commercial bank, a standard bank, they usually deal with individual and small companies. So when you get to the larger companies, that's when you're usually talking about the investment bankers that are going to have that specialized type of role to deal with those larger type of transactions. When you're thinking about small individuals, mortgages, and small business loans, then you're typically thinking about the commercial bank. So the commercial bank pays out smaller amounts of money typically, and when you're dealing with the smaller amount of money payouts, then you're typically dealing with less risk per transaction. And then they're usually dealing with mortgages to individuals. That's going to be one of the main kind of things with an individual transactions, because those are fairly good size when you're talking about individual transactions, the purchase of a home and the loan related to it. And then they deal with small business loans as well. And the profit will typically be generated in interest. So when you think about a normal bank, you're thinking, all right, they're making small business loans, they're making mortgages, loans to individuals, and they're going to be making their money off of the interest. On the investment bank side of things, you're thinking about banks that are taking on larger risk. They're going to deal with large companies and high risk startups. So now you're talking about companies that need a lot of money in order to do the startup, or companies that are thinking about expanding and they're very ambitious in their expanding. They're going to need a lot of capital. And so we need to consolidate and put a lot more money together in order to meet these types of needs. They act as a bridge between the companies and investors. So you got these companies, big startup, big change that's going to be happening, and you need to get a lot of capital that's going to be consolidated together to meet the needs that these large companies are going to have. Now, if you want to see a connection between these two, this isn't one that usually make the investment banking community look as good, but it's often one that's going to stick in people's mind because of the housing crisis and basically the Great Recession that happened in 2008 or 2009 started from. You'll note that on the commercial side, at that point in time, the banks were making loans. They were making loans that were not quite so secure after a point in time to individual investors. In other words, normally when you think about a home loan, mortgages that would be made from a bank to the individual investors, they're thought to be highly secure type of investments on the bank side of things because the home itself will secure the investment. But usually that requires also a down payment and some requirements in terms of the ability for the person who is paying off the loan to actually be able to pay it. As those kind of regulations got lessened, we had loans that became more risky even though the home was there as a security. So that transaction you can imagine happening on the commercial bank side. But then you can imagine the commercial banks selling on the secondary market to the investment bank those mortgages that they took into place. So now you can see what happened on the commercial bank. They sold to the individuals, and then they took those loans and they sold them to the investment banks, who could then buy multiple amounts of loans, and they can then say, okay, these loans are highly safe loans. They have a little bit of risk usually because they're supported and backed by the houses that will be involved. Now, of course, the problem is that these loans became a lot more risky over time, and it wasn't known how much risk was going to be involved in it because the changes in the regulations and whatnot, because of loans that were being given that were less, they had a lot more risk, possibly less down payments and so on. But then you can see the investment banks then packaging those loans into securities and then selling them on their side. So you can see on the investment bank kind of taking in a lot more risk there because they're going to be picking up a lot of mortgages on the secondary market and then packaging them into some way that they could basically sell them again. So that's one example where you can kind of see a difference between the commercial bank and the investment bank. That particular example doesn't make either the commercial bank or investment bank look particularly good, but I think it's a good example because it's probably something that's still fairly fresh in people's minds. So notice, of course, the commercial bank and the investment bank are going to be a critical process within the economy to facilitate transactions. We have the Gramm-Leach-Bliley Act of 1999 allows banks to offer financial services previously forbidden by the Glass-Steagall Act. So the Glass-Steagall Act was going to limit or put limitations on what banks could do. It was thought that the regulations went a little bit too far and handicapped banks too much. And then so that was basically removed because it was thought that banks were in a good position to basically do these types of services and possibly with regulation could do them well. So each manager or service person is only allowed to sell or manage one type of financial product instrument. All banks must share their information sharing practices with the customer. So the investment bankers are the middlemen in the securities distribution. So some of the components we're going to talk about in more depth include the underwriter, market maker, client advisor, agency services to corporations. So the underwriter contracts to buy securities from corporations and resell them to security dealers and the public. So the underwriting process is that process where you can imagine the company then going to the investment banker. The underwriting is going to be the commitment of the firm then to take on the securities and then try to resell them. So the underwriter, quote, firm commitment, end quote, to purchase securities from the issuing corporation. So they've made a commitment, basically a contract at that point, assumes risk associated with the new issue. So you can imagine then a typical situation where the corporation possibly issuing the stock then that expects to be sold to the public at the end of the day, the underwriting process committing the firm then to taking on those stocks, which they then expect to sell at a later point in time. Now, obviously, in that process, what is hoped to happen by the bank, by the people taking on the risk here, is for them taking on the risk and taking on these stocks, they get the discounted price of the stocks, and hopefully they can sell them at the end of the day at a higher price and ultimately to the public. So attempts to sell security issued to the public on a pro rata commission basis. We have the market makers. These are going to be individual market participants or member firms of an exchange that also buys and sells securities for its own account at a price it displays in its exchange's trading system with the primary goal of profiting on a bid-ask price. So they're basically going to say, hey, look, this is what I'll buy it for, this is what I will sell it for, and then of course they make their amount of money on the spread between the bid-ask price. So that's going to help smooth out, hopefully, the distribution of the funds of the shares and make the connections so that those shares can be sold. The brokerage house is the most common type of market maker that provides purchase and sale solutions for investors attempting to keep financial markets liquid. Market makers are compensated for the risk of holding assets because they may see a decline in the value of security after it has been purchased from the seller or before it's sold to the buyer. So once again, as that middle person, they're taking on some risk there, and of course they should be compensated for the risk they're taking on because they are adding value to the process by smoothing out the process so that these shares could be sold on the market more smoothly, more easily. Then we have the advisor. Advisory services in areas of mergers, acquisition, leverage buyouts, and corporate restructuring. These are obviously very large types of decisions and are going to need, advice going through the process for these types of activities. Advises clients on continuing basis. Topics may include types of securities that will be sold, the number of shares or units that will be distributed, the timing of the transactions. We have the agency function. So playing the role of an agent attempting to negotiate the best deal with potential investors. So when you're acting as an agent, you're basically acting on someone else's behalf. So you're acting in their best interest The most common example is like a lawyer in a criminal type of case. That's what comes to most people's mind. If you have some kind of legal problems and you hire a lawyer, the lawyer possibly can then act on your behalf, actually making decisions on your behalf. And in doing so, they should have your best interests basically in mind. They're acting as an agent for your best interests. So attempting to place the corporation's securities with insurance companies, pension funds, wealthy individuals. So the process could look something like this. We might have corporation issues additional shares of stock. So in other words, the corporation wants to generate capital. They issue stocks to do so. Now that could be a large amount of stocks that they need. They might have some advice in terms of how many stocks they need to issue, what the price of the stock could be, and so on and so forth. And then we have the managing investment banker, which is going to be work. That's where the investment banker comes into play. We're talking about the middle person in this case. Now, if it's a large amount of stocks that are being issued from the corporation, the bank might be saying, hey, like that's a lot of risk for us to take on. Let's go to an underwriting syndicate where we have multiple investment bankers that can pass on the risk that will be involved. So we might then have an underwriting syndicate which will basically spread out the risk so that not one institution is taking on a substantial amount of risk, which could be the case if you're talking about a large corporation that wants to generate a large amount of capital by issuing a lot of stock. Selection of dealer groups, and then we finally have the brokers, which of course will then make the actual sales to the public. So the investment banking distribution process, the principal investment banker calls for other investment houses to take on the risk and help with distribution. So you might have this situation again where they spread out the risk. You have this large company that they're going to want to spread out the risk with other investment houses. And then they may have an underwriting syndicate with many investment houses, once again spreading out the risk. The syndicate members then act as wholesalers, distributing shares to brokers and dealers. So a wholesaler, basically the idea being you're buying in bulk, taking on the risk as you buy in bulk, but in so doing, you get a lower price, and then you're going to be distributing to the brokers and dealers, and you're going to be cutting it up. Now, you bought it in bulk, now you're going to be cutting it up. When you give it to the brokers and dealers, then they're taking on less risk given the fact that they're buying smaller chunks. They're not buying the wholesale chunks, and therefore they're going to have to buy it at a higher price because they're taking on, and then they're going to sell it to the public at a higher price from there, right? That'd be like the retailer. So brokers and dealers then sell shares to the public. Obviously, when they sell it to the public, then the brokers and dealers are going to mark up the price and then sell it to the public at that level so that the public can then buy the smaller shares that they want at that point. So underwriting spread, the difference between the amount that an underwriter pays an issuer for the securities and the total proceeds gained from the securities during a public offering. It marks the underwriter's gross profit margin, which is then deducted for other items like marketing costs and the manager's fees. It will vary on a deal-by-deal basis depending on many factors. So it might look something like this. You can imagine the process just in terms of putting some dollars to it. You just made up some dollars here. So the managing investment banker, say we have the stocks for the $25, and then the other syndicate members possibly marked up at the $25.50. Then we have the selected dealer groups at the $26. Finally, the brokers at the $26.50, and then going to the public at the $27.25. Just to put some numbers to it, so it might make it a little bit more concrete in your mind.